right, I think we have success. So let's see, we take a break after the first couple of minutes and see if this is recorded. My actual work, which is important, will come after this, which is definitely requires recording. All right. Okay. The light is red and everything is good. All right. So, ladies and gentlemen, let me just recap. Sorry for the late start. The difference between wealth management, asset management, funds management, portfolio management is ever so subtle. All of these are a group of management of investment, a type of management of investment. And they differ based upon who you are managing the investment for. When you are creating a portfolio, regardless whether it is for one individual, for many individuals, for a rich person, for a not so wealthy person, for an institutional investor, they are all portfolios. And managing of that portfolio is, of course, portfolio management, which implies understanding what the investor wants, what can you invest in the market, so two different things, what the investor wants, and what are the investments that you can make in the capital markets, and see if you can bring them together. Can you achieve investors' objectives? That is the idea about management. The next aspect about management is this, and you'll see this as we go along, that markets are not stable. Capital markets keep on changing depending on new information that comes into the market. And based on new information coming into the market, investors will change the way they behave. Now, I know this is a very topical question, but how do you think markets have played out in the last several days? Because some important event has taken place in the last several days, right? That has kind of shaken up the market. What is that event? Sorry, I thought you were going to say the other way around, Kim, but yes, Donald Trump, Kim. These are the two aspects which are the unknown quantity in the market. What happened to the market? What have you observed?
A lot of volatility, sharp drop.
Volatility index has increased. That's not just in Australia, but also in the US. In fact, the US, you see a lot more volatility. Yesterday there was a news that the volatility in US is at the same level as when Trump was elected, slightly below that. The difference was when Trump was elected, the markets were going up, and now the markets are going down. Remember, ladies and gentlemen, markets are a lot more volatile when they're going down than when they're going up, all right? So keep that in mind. Okay, so markets have been affected. Investors don't like uncertainty, and so they change their investment behavior. Where is the investment going now? What are the assets that investors are investing in? Pearl? When there's uncertainty in the market, where do the investors go?
If the market is volatile, then they will turn to government bonds or some like high safety assets.
Good. We call them safe havens. What are the safe havens? Do you know the names? Well, you mentioned one of them, government bonds. What else? Yeah, but what part of capital market? Sir, what is safe asset? Where do you get safety? Yes, that was bonds. What? Yes, that's another aspect that has gone up. If you notice, gold is sitting about 1280 at the moment, right? So gold, silver, platinum, they all went up as a defense. What currency goes up? What are the safe currencies? Yourself, sir. What if you are unsure about what's happening in the market? Where would you park your money? Which currency? Japanese yen. I know there's a thought that when there's uncertainty in the market, all the Japanese rush back into their home country and into the Japanese yen. But that might be very Japanese centric. But globally, nope. Australian dollar is risky. What are the two currencies which are considered to be safe havens? Yes, of course. Number two. Which Europe? There's many Europes because there's Euro Europe, then there's the Sterling Europe, then there's the Swiss Franc Europe, then there's the... So which Europe are you talking about? Sterling, that's different, that's UK. And you are right, there would be an increase in sterling as well. The second most important currency, ladies and gentlemen, is the Swiss franc. Swiss franc. Oh, you knew about that, sir? Oh, yeah. and you know what? This is very interesting. Swiss franc has been traditionally a safe haven. Switzerland has been traditionally a safe haven. It's always tried to remain neutral. In fact, it encourages money laundering. Sorry, I didn't say that. It does not care about if there are issues regarding anonymity. All right. So what you realize is that there are differences in what happens in the market. Market conditions change. Different assets behave differently at different times. I want to show you that today. Now comes the issue of the differences between these aspects. When you are creating portfolios for a single client, it is called portfolio management. These are portfolios constructed for one entity or individual. These are portfolios. And the person who's creating that portfolios and managing that portfolios is a portfolio manager. Portfolio manager is generally looked at when they're constructing portfolios with large amounts of wealth. So we're talking about $500 million and so on and so forth. And those would be essentially for institutions. For example, you guys might have seen some, and I've given you, well, to some population over here, a document which is called University of Southern Michigan, Mississippi, Southern Mississippi. If you haven't got it, I'll be printing out a little more of these. This is a document which is the investment policy for a university endowment fund. All right? Does anybody know what an endowment is? So you know that. You don't? Do you know what an endowment is?
It's donated from the society.
Very good, miss. Excellent answer. Endowment fund is a donation collected from the alumni of, when we talk about university, it will be the alumni. Alumni are people who graduate from the university, like yourself, and you'll get a letter from the university saying, oh, can you help the university? And then you'll give some money. So that goes into an endowment fund. That is managed by a team of professionals. Our University of Adelaide has an endowment which is about $500 million. Well, less than $500 million. On the other hand, Harvard and Yale. Have you heard of these universities? No, never, miss? Never heard of a university called Harvard? You have, right? Oh, no, she hadn't. Never? It's a very famous university in the US. So they have an endowment fund which is sitting around $40 billion. All right, so notice the scale over here. When we talk about individual clients, human beings, the management of that is either done on a mass basis, which is funds management, or it is done on an individual basis, which is wealth management. So you are looking at managing wealth of wealthy individuals, those that are investing more than about, generally speaking, about $5 million above, and they are looking for very specific aspects. And you have, you will learn of those aspects later on in the semester. However, at this point in the time, what we're going to teach you is how to invest and how to identify the assets in the market, the fund managers in the market that you are going to use to run this portfolio. All right? So just before we start, as the first step, what we're going to do is we're going to identify clients. And what I've done is I've given you two documents. One is, of course, the University of Southern Mississippi document, which I'll give more of. But the other document is called a roadmap for the roadmap. Here's a document. Just in case you don't have it, I've got some copies over here. This document shows you how to create an investment policy statement. An investment policy statement is a statement which tells investors what they are going to achieve And how are they going to achieve this? The various aspects of it. So we're going to look at that. So what the reason I've given you these two documents is that a portfolio manager cannot invest in the market not knowing what the investor wants. And if you think about the investor, there are two kinds of answers an investor will give when asked, what do you need or what is your investment objective? First answer is, I want the highest return possible. And the second answer is, I want a return which is 5% above CPI. Two answers. I want the highest return possible, and I want a return which is inflation plus 5%. What's the difference between these two answers? Do they both sound logical? I want the highest return possible. I want a return which is inflation plus 5%. Sorry?
Different risk preferred.
Okay, so what's the first one?
Is a risk seeker.
Risk seeker? What kind of, sorry, what kind of characteristic will this investor have? Will this investor have a lot of money?
Yeah, they want to earn much more.
Oh, no, I'm not talking about what they earn. I'm asking, what do they have that reduces their risk aversion, that makes them more risky? What do they have that says, look, I'm willing to take risk?
Probably small stock.
No. I'm not talking about what investments they are making. I'm asking, what do they have in terms of characteristic? Do they have a very nice social support that they don't mind losing money? Do they have a lot of money?
Yes, they are very rich, and maybe they will have some of the knowledge about the finance.
Remember this, Pearl is almost on the money. We're talking about an investor who says, I want the highest return possible. What's the problem with this statement?
They didn't care about the risk.
They didn't care about. That's what you're attacking, right, miss? They are talking as if there's no risk. What kind of people make these statements? And on the one hand, Pearl says that, oh, there must be somebody who's very knowledgeable. But somebody who doesn't talk about risk, can they be considered knowledgeable? I mean, they have to be multi-billionaires, right? Like Trump, right? He says, I don't care. I'm just going to bomb North Korea. I don't care. That's the idea about having, when you say, I want the highest return. Because this statement is usually made by individuals who have no understanding of risk and return relationship. When you want high returns, it does come with high risk. And I'm not talking about people who are not educated. I met many of my family members who say, oh, Aku, you teach finance, can you help us invest? And I say, well, what do you want from your investment? Highest return possible. And you go, okay, I don't think I can talk with you till I educate you. So there has to be an education process. The second example, when we say CPI plus 5%, that's a very logical answer. It says, I want to earn 5% returns in real terms after the effects of inflation has been taken out. Did you notice these two differences? It talks about not taking too high risk. It talks about not taking too low risk. Just the right amount of risk. So when you frame your answer in a benchmark plus something, it gives you an indication what the risk level is. And you'll see that later on today. All right. So I show you this as a first slide because I find this very interesting. This is the difference between a individual and an institution, or somebody who's more knowledgeable. So when we talk about institutions, we talk about investors who are a lot more knowledgeable. They understand how investments are made. They understand the risk and return characteristics of various assets. And they have very different way of behaving than individuals. Now, as far as your work is concerned, most often you will be dealing with individuals. You will be dealing with rich families in wealth management. You might even be dealing with institutions, entities in a way. And that way is through trusts. Have you heard of this term before, trusts? All right, so trust is a way, it's an entity, it's an investor on paper, and they are slightly different. So this is where your main focus is going to be, individuals. And what you note about the individuals is this, that the way they understand risk is very different from the way institutions understand risk. Institutions have a very easy way to say it. They say, well, we need to be, first of all, very logical. Can we achieve our investment objectives? What is the ability for us to achieve that investment objective? When we say inflation plus 5%, how many times in a year will I be able to achieve that objective? How many times I will not be able to achieve it? So that percentage gives you an understanding of risk. For example, you can say, I will be able to achieve this investment objective 90% of the time. Good, I have an understanding. 90% of the time, we'll be able to achieve that, 10% not. So I can see where the risk is. As far as individuals are concerned, they get panicky for the wrong reasons. For example, market volatility makes them panic. The moment market volatility starts happening, they'll be calling you and saying, what's happening? How are you keeping our investments safe? I'm not kidding you. So the first person they'll call is you, nobody else. And so you have to explain and make them understand how the market is, where the market is, and how the market is going to proceed in the future. So on the one hand, dealing with institutions is much easier because they actually understand finance. On the other hand, in terms of remuneration, it's really hard. They are very, very smart, savvy investors, and they're able to reduce the margins or profitability. Individuals are a lot more profitable, especially in wealth management industries. Something that I must tell you, that during the global financial crisis, it was the wealth management that gave the profitability to financial institutions. Individuals want that assurity. So we'll be looking at this idea, but in a little more holistic way. All right, so for the next thing I want to mention is, what should an investment policy statement look like? This is where your roadmap for roadmap comes in. It shows you how to, and I've taken up excerpts from here and put it in the overhead as well, so you can see where it's coming from. And this then, the Southern Mississippi University is the example, the true example of a roadmap, IPS. So the IPS has a couple of aspects. The first one is going to be some details about who the clients are, why are they investing, and who are the various parties that are involved in this process. The parties are generally going to be the client and the fund manager, all right, or the portfolio manager. Over here, bullet 4 lists the investment objectives of the client, all right? So it cannot be just return. It has to compare both. It has to understand both aspects of a client, the risk and the return required. Now, it's very easy for investors to understand what return they require. Once you tell them that high risk comes with high returns, and you know, you are able to lose a lot of your money if you invest high risk, highly risky investments, the next step is to make them understand how much money or what kind of return they need. Now, let me ask you this question. How do we work out the returns required by an investor? How can you work that out? Sorry? Actually, there's no model required. Right. There you go. All right, so it's just a simple example. Your initial investment is $100, and you're investing for a period of 5 years. And at the end, you need to have a wealth level, which is $150. So, what's the implied return required from this investment? Sorry?
50% for
Yeah, so? Per year? Sorry? It's a very easy calculation, right? You need $50 for your $100 investment over a period of 5 years, right? So per year, what's the investment required? What's the return required? So there you go, 10%. All right. So the return required is 10%.
Is that not taking into account compounding?
Yeah. I'm talking very simple. I'm just talking very simple language. Just to get an idea going. All right. Now, to achieve a 10% return, first question is it possible? Can we achieve a 10% return over a 5-year period? Is it possible? All right, give me an example. What are the different assets I can invest in to give me that number?
Maybe we can invest in derivatives.
Sorry? Derivatives. All right. I know you're going to say that's leverage investments. I'm going to keep it very simple. Just simple investments, so no derivatives. Sorry? A stock?
Other one is bond.
Good. So what's your name, sir? Your name?
My name,
Yeah.
Jin.
Jin. All right. Jin is absolutely right. I have 2 assets that I can invest in from the market. He's not naming a specific stock. He's saying generally I can invest in equities and generally I can invest in bonds. Now, Jin, because you seem to be have a good understanding, what kind of returns do I expect from equities in general? What kind of returns? On general, I'm not saying this year or the next one day. In general, what kind of returns do you expect? Give me some number.
Maybe like 50.
Sorry?
50.
50?
50.
15. All right, cool. So you can get the expected returns from equities is about 15% per annum. What about bonds, Jen?
Maybe like 7.
7, all right. Jin, why are you so optimistic? All right. So, Jin, to get that 10% return, give me a portfolio. How much should I invest in bonds and how much should I invest in equities to give me that 10%?
Would I calculate?
Okay, if you want to. If I did half-half, what kind of returns will I get?
Is 7.5 plus 3.5 is 11.
11.5. Sorry, 15 plus 7, 22. 11 exactly. Beautiful. So that's slightly more than we need, right? At 50%. So if I have a portfolio, and this is 50-50, the expected return on the portfolio is 11%. Jin, are you happy with that? Yeah, you're happy? You want to give them more returns than they asked for?
Maybe not, because I will receive more risk.
Okay, so?
So I will buy more bonds.
Okay, so let's say we get 60% in bond and 40% in equities, yeah? Cool? So what what Jin is trying to do is this. He has made a forecast for his 2 asset classes, and now he's trying to work out how much should he invest in one of these 2 assets, right? Correct? All right, Jin. Very good. I'm very happy with this result. So you're coming down to probably approximately 10%. I'm not going to calculate this. Now, when Jin said that this is the portfolio, What could go wrong with this analysis? What could go wrong with this analysis? It looks beautiful. The investor wants 10% return. Jin is giving them 10% with a high investment in bonds. Seems quite safe. Man, that sounds like a perfect solution. What could go wrong?
Might be too high risk for the investor.
Okay, number one, investor says, I can't invest in 40%. This risk is too high. So one, risk too high. And of course, we have to figure out how to calibrate the risk that that investor is willing to invest in. What else could go wrong with this analysis? How about you, miss? No, everything seems good? There's nothing that you feel that could go wrong over here. Sorry? Okay, go on. Yes?
The price could also drop down.
For which asset?
The equity.
Equities could go down. Well, if equities go down, so you're saying it won't be 15%, it'll be less than 15%?
Yeah, it could be negative.
Ah. Jen, did you hear that? She says equities could give you negative returns. She says 15% is too high.
For 1 year, I
I didn't say 1 year. We have to invest for 5 years, mate. You can't pick up one good year and say that's what's going to happen for the entire 5 years. So the next part is, miss, what's your name? Me. So what me is saying is a very important point. Expected returns, 1, too high, and 2, not stable. Correct, Jen? Me? That's your point. She's saying, look, I don't think 15%. Come on, when did we last get 15% per annum? You tell me. Most of the time, we're sitting about at 10, 11%. So this 15% is too high, and that too could go into negative territories if, for example, there's global financial crisis. When there's a global financial crisis, let's attack one point at a time. Expected returns long term. Jin, how did you come up with the expected returns of 15%?
for long term.
Yeah. How did you think it was 15%? What was the information that you got that you used to come up with this number, 15%?
Because we have inflation from
Sorry?
because we have inflation, and I know the stock price will increase like this, and the bond will like this. So in the long term, I think the 15% is.
All right. So, Jin, what that means is that at the moment you're kind of not really sure how you got that 15%. You think that 15% is higher than 7%, which is fine. So equity should give you higher return than bonds. But is 15% okay or not? That should be something that we should know, right? Because you need to give this information to your client. And the second part that me also identified is that in some points in time, the returns on equity will go down when there's a crisis. Now, here's a quick question, ladies and gentlemen. When there's a crisis and equity goes down, what happens to bond prices? Why?
Because investors shifted their assets.
This is a very important question. And I ask this question because that tells me whether you understand equities and bonds. Why should bond prices go up when equities go down? We're not talking about a flash crash. Does everybody know what a flash crash is, sir? Have you heard this term before, flash crash? Yeah. Me's on fire today. Me, go on, tell us. What's a flash crash?
It's a kind of investment overseas that come into one country very quickly and go away very quickly.
It doesn't have to be that extended that it comes from one country and goes to another country. Not that required. If somebody sells too much of one thing, usually using derivatives, Jin, then what happens is the market investors suddenly see the price falling down very quickly. And then as soon as that happens, people think, maybe something went wrong, and then they buy it back. So the market dips just for a maybe couple of minutes, and it comes back again. A lot of times that has happened in the market, generally because of bad trades by traders. In that event, no change to bond market. But if the equity markets are slowing down, why should the bond markets go up?
Because they are to call asset,
Okay?
and then when there's something happen with the equity, so they will change to the safety asset, which is the bond, and they have the high demand for bonds.
That's what Me said as well. So Me says that when investors move from equity to bonds, they get some, the bond prices go up, equity prices go down. Bond prices don't go up because of that easily. How are bonds priced? Have you guys done fixed income securities? Yeah? So how are bonds priced? Is there demand supply in bond prices? Go back and what Tariq taught you, or RT, or whoever taught fixed income securities. How are bonds priced?
It's risk-free plus market risk appraisal.
So price of bond, how do we get that?
Risk-free rate plus.
Present value of cash flows. Simple. You just look at the cash flows of a bond and discount them back. How do you discount them back? At what rate do you discount them back? This is what Me was trying to explain. She was trying to talk about the yield to maturity. So you discount it back on yield to maturity. So these are cash flow 1, cash flow 2, last cash flow, 1 plus YTM to the power 1, 1 plus YTM to the power 2, 1 plus YTM to the power N. Do you guys remember this equation? So, when we are pricing bonds, it is based on the term structure and, of course, yields. Of course, term structure and some components based on risk. So, what happens when the equity markets are going down? That bond prices go up based on this formula. That's right. As equity markets slow down, the central bank, it says, oh, economy is slowing down. So what do they do with the interest rates? They reduce interest rates to stimulate the economy, right? As interest rates go down, these yield to maturities decrease. As the yield to maturity decreases, what happens to the price of bond? Do you see that? It is a very simple equation that as equity markets slow, we are not talking about flash crash over here, right? We're talking about a true slowdown in the economy. As markets slow down, we saw this during global financial crisis. We saw this not just in the US, we saw this in UK, especially after the Brexit. They reduced the interest rates. Why did they do that? They did that to stimulate the economy. When they do, and why are they stimulating the economy? Because the market is slowing down. So they are trying to do these two things. The result is, of course, bond prices go up. So now, let's go back over here. Same question. When we see equity markets go down, we note bond prices go up, bond markets go up. We see the reverse. When bond markets go down, because the yields have gone up, resulting is equity markets go up at the same time. So we have a very nice balance. And that is why we invest equities and bonds in a portfolio. One is to preserve from market downturns, one is to gain from market upturns. Equity gains from market upturns, and bonds are defense in market downturns. So what we understand is this, that first, these numbers need to be checked. Second, we need to know what happens when markets go down. How do these numbers change? Because that will have a direct impact on our portfolio, the returns that we get from our portfolio. Remember, The question is always going to be, can we achieve this 10% returns or not? How easy is it? How much volatility do you have to take to achieve this 10%? And that will have an impact on the clients. Now, ladies and gentlemen, I'm just going up. So we're going to discuss the objectives, risk return. This is going to be our key focus. The other aspects that also impact the asset allocation are the constraints, how much liquidity the clients need, how much is the investment horizon. These two are the key aspects. So we note that when investors have long investment horizons, they're able to take more risk. And there are many, many reasons for it. At this stage, all you have to do is think, the longer the investment horizon, the more ability to take risk. The shorter the investment horizon, less ability to take risk. Yeah. The second thing is liquidity, which is very important for us. Higher the liquidity needs, less ability to take risk. All right. Because when you need liquidity, you have to invest in assets that provide that liquidity. And assets that provide that liquidity are usually low risk, low return assets, like bonds. So these two are going to be the key focus. But other than that, there are a couple of other aspects that I mentioned, for example, taxes. I'm not going to discuss taxes in this class. Unfortunately, I don't have that background. I'm not going to talk about legal and regulatory aspects. Again, you'll learn this down the line. You have a couple of sessions. And I'm not going to discuss unique circumstances either. So my focus is going to be just on risk return as objectives and liquidity and time horizon as constraints. All right. So once we have identified that, the portfolio manager then creates an asset allocation, just how we had this conversation with Jin, that what assets can we invest in? He says equities and bonds. Then you come up with an estimate of what the expected returns are going to be, and you decide on the asset allocation. How much in equities, how much in bonds. If Jin was going to go with 3 asset classes, Jin, what would be the third asset class? Don't talk derivatives. Anything other than derivatives. What could be a third asset class that he could invest in? Real estate. Beautiful. So once you get real estate, now you have to think, what is the expected return of real estate? What's the risk of real estate? And how they can combine with each other. All right. So we look at that asset allocation. I've got 2 terms over here. One is called the target, which is what we call the long-term asset allocation. And then over here we have ranges. Ranges means short-term deviation to take advantage of market conditions. So for example, remember when we talk about equity markets going down, chances are investors, as you mentioned me, will move more towards bonds. Yeah? And that, how much can they go towards bond is restricted by the ranges over here. So, ladies and gentlemen, I would like to now take you to couple of pages down, which is just talking about the risk and return I know we just discussed this, but I thought I'll bring it a little more formally. When we talk about investment risk objectives, there are a couple of different aspects that we can look at. First up, should we consider absolute or percentage returns? And the answer is, generally talking about absolute dollar terms can be helpful, but it is best if you complement it with percentages, and we show you how we do that. Generally, percentages makes your life much easier because you can analyze it in the context of, regardless what the investment wealth is, I can figure out what the return should be. Over here, I've got 3 different bullet points of how the investor could demand returns. The first one is capital preservation, the second one is capital appreciation, and the third one is current income. Now, I'm not saying they're all mutually exclusive. That means it doesn't have to be one or the other. They can also be combined. But generally, when we note investors, they will either talk about preservation or appreciation. So these are really the 2 focus that we can have. Preservation means that your wealth will remain the same in real terms. All right? Real terms. Now, Does everybody understand real returns? Yeah, sir, tell us.
So real returns excludes inflation.
Beautiful. I need to hear that point, and I need everybody to hear that point, that real returns excludes, takes out the effect of inflation, which says how does your wealth grow in real terms? That means without dilution of inflation, right? So how do we work out real returns? If my required return is 10%, sorry, if the required return is 10%, what is the real return? And inflation is 3%. So what is real return? 7%, right? It's a very important aspect that you understand, because a lot of people make mistakes in trying to figure out whether real return includes inflation or excludes inflation. The point this gentleman makes is, sir, what's your name? Michael? The point Mike makes is very important. When we talk about real returns, it excludes inflation. It means so if my value of my portfolio does not change in real terms, I've achieved preservation of capital. So preservation of capital, your portfolio remains the same in real terms. Capital appreciation, on the other hand, is where your portfolio grows in real terms. Now, let me just focus on these two aspects, just very quickly, so that we understand each other really well. If I have a portfolio, if my initial investment is $100, yeah, and the return, the expected return of this portfolio is 5%, which is nominal. Inflation is 3%. I'll make this a little better than that, 7%. So if my expected return nominal is 7%, my inflation is 3%. Yeah? So that means my portfolio is earning 7% returns nominally and 4% in real terms. How much can I consume from this portfolio while preserving capital? I know it's a very simple question, but I still want you guys to understand this. So how much can you consume and still maintain the portfolio in real terms? Not you, Michael. How about you, miss? You're getting your portfolio is $100. Your return is 7%. The inflation is 3%. How much can you consume, sir?
4%.
Beautiful. Oh, for a person who said you don't understand what's going on, that was a spot-on answer. 4%. So that means if I consume 4%, I lose 3% to inflation, I'm back exactly where I started. That is capital preservation. So that means I can only consume 4%. Suppose instead of consuming 4%, I only consume 2%. Am I preserving capital, or am I growing my capital in real terms? There you go. So if I consume less than the total, this expected return inflation, I'm actually growing my portfolio. So please understand this, that to grow your portfolio for capital appreciation, you cannot consume everything that you earn. You have to reinvest in your portfolio. And in capital preservation, you consume as much as you earn, less inflation. Current income and total returns are just two different ways of splitting that returns. And I'm not going to be bothered by that. So we're just going to focus on either preservation or appreciation in this term. Then we come to risk. And this is a aspect of debate. So, ladies and gentlemen, how do we measure risk? And I've given you a couple of ideas over here. The idea that you know of from the time you first started learning finance was volatility, right? So you said standard deviation is risk. And that's what happened, right? You go into a class and the lecturer was there saying, standard deviation is risk, standard deviation is risk, volatility is risk. And by the time you come out of the first semester, all you have in your mind is risk is equal to standard deviation. Why? Why is risk equal to standard deviation? So, where is the connection between volatility and uncertainty? I know you know the answer, I just want you to explain it to me.
It's just possible that you can't get what you want.
Come on, miss. You can almost get there. So, here's my volatility of returns. Right? This is a highly volatile asset. And that's his mean. So that's his mean. That's his standard deviation, correct? And then I have another asset, with my sparkly pen. Yeah? So, what I've done is I showed you two assets. One which is more volatile, its mean is higher. One which is less volatile, its mean is lower. The aspect that me was saying was this. When we look at the returns in the past, we can see it moves up and down, and hence you have higher volatility. Right? The average of these returns is this mean. An asset which has low volatility will have lower mean. Correct? Chances are whether you're up or down, you're still close to your mean. You're close to, as what me said, expected returns. But when you're looking at a more volatile asset, you could be very high above the expected return or much lower than expected return. And that is the uncertainty me is talking about. And of course, there could be an asset which is like this, right? It could be something like this. Right? And that is the least risky asset. So notice, as the volatility increases, of course the average will increase as well. But then the risk is that you may be either much higher than what you normally should expect or much lower. Correct? Okay. So that is the connection between risk and volatility. Wait, what's this? What's the problem with this? Wait. What's the problem with this volatility figure in understanding risk? If I tell you an asset has a volatility of 15%, is that risky for you, miss, or not risky enough? What is not risky enough for you that you can safely invest in, that you feel that you're comfortable? Volatility times, yeah? So what volatility are you comfortable with? 5? Okay. If I ask this lady, how did she come up with these numbers of 5 and 15?
Because it might be increase or decrease from the average.
And how do you figure this out? 5 and 15. Pearl? High risk, how much risk are you, sorry miss, what's your name?
Chan?
Chan?
Yeah.
Chan, how much risk are you able to take in terms of volatility?
I compare with my expected return.
Okay, yeah. Give me the volatility. Higher the volatility, higher is the expected
For
return.
example, if I expect 50% of return, I might just can accept 5% of.
Chances for 50% return, she can only accept 5% volatility. How about you, miss? How much volatility can you expect? Accept. At this point in time, you guys are just coming up with numbers. There's no basis for it. You think 15 sounds too much. It has two numbers, 1, 5. No, if I can get it 9, but 9 is too high. It's almost 10. So maybe 5 is good. Maybe that was your logic, miss. The way we do it is slightly different. And Chan was almost right, because she said you have to relate it to the expected return. Something that you learned by a very, very lovely boy who was my student many, many years ago, George. George taught you quantitative methods, right? Oh, what did you learn in quantitative methods? Did you learn something called a normal distribution?
Yeah.
Ooh, what's the normal distribution, Chan?
It's symmetric shape.
Okay.
Bell curve.
Symmetric, like bell shape or like a horse shape?
Bell curve.
Bell shape. Not a horse. Good. What else? Is symmetric. So this part is equal to this part?
Yes.
Correct. What else is true about normal distribution? What else do we know about normal distribution? One more aspect, and then we're done. You're almost there, Chan.
95%.
Ooh, that's it. That I can estimate how much or where I am on this distribution based on only two aspects: the mean and the standard deviation. So as Mike says, if I look at one standard deviation either side, how much of the area do we cover? No, one standard deviation.
70%.
Sorry?
70%.
No, that's too high, Chan. You're overestimating the probability.
60%.
Yeah, 68. I'll accept 68. If you had said 67.5, I'd be happier. All right. So what does this 68% mean? Let me give you some numbers so that we can put this into context. Mean is 10%. Standard deviation is 15%. So, Miss, I'm going with what you said. All right. So what does this tell me? If I knew these two numbers, what conclusion can I reach? Oops.
95%.
Where's the 95%, sweetie? There's 68%.
No, I mean 95% maybe the loss.
Okay. Okay, so, come on, people.
Your return will be from that range. -5% to 25%.
There you go. Perfect, Pearl. So what she's concluded is this. My returns from this investment will remain between -5% to 25%, 68% of the time. Right? What happens 32% of the time? What happens 32% of the time?
The return will be out of this range.
Which means less than -5% or more than 25%. Now we go back to your question, Miss. Are you happy with this level of risk? So 15% is okay for you. So now, this is back to Chan's point. It's very important that you understand what your expected returns are, understand what you could lose and how much you can gain, and then work out, are you happy with that level of volatility? So most investors are just looking at this figure, if at all, and they're judging whether this number is high or low. You cannot do that till you understand how high or how low your returns could be. Now, back to 95%. If I look at two standard deviations, I'll get 95% of the area under the curve. Now I have an even better picture that when markets behave abnormally, so generally we say one standard deviation is normal behavior. When you go above 1.5 to 2 standard deviations, that's abnormal market behavior. And over there, we have the chance of losing to this level or making up to that level. It gives you a lot more insight as to what you're investing in, all right? So this is where standard deviation is good. What is the downside of using standard deviation as a risk measure? Positive, I just showed you, it's great. I can get an understanding of how much I'll make or how much I'm going to lose. What's the negative aspect?
You need relies on the mean, so you need historical data.
All right, so I need data. All right, cool. What else? What else?
It also makes a number of assumptions that returns are normally distributed.
That is number one. We are assuming returns are normally distributed. and unfortunately, ladies and gentlemen, I'm going to give you the bad news. Returns are generally not normally distributed, unfortunately. What else? What else is the problem? It says that whether you get -5% or as high as 25%, your expected return was 10%, right? If you get 25%, is that a risk for you? I mean, Chan, are you going to say, oh crap, I'm going to get 15% more. This is terrible news. You're not going to say that, right? What are you going to say?
It's good.
Yeah. So that's the second problem with standard deviation. It doesn't say the good risk, it doesn't distinguish between good risk and bad risk. Good risk is when you get more than expected. Bad risk is when you get less than expected. What do we care about? Do we care about the good risk or do we care about the bad risk? And the answer is what we care about is how much we're going to lose. Or another way to think about it, and I'll just put it back over here, is the first point that I make. Man, I keep on just jumping back. This one. The chance, the ability, the prospect of not meeting your investment objectives. What is the chance? And what we look for that is not volatility, which is symmetric, but something which is downside risk. And one of the famous downside risks that we talk about in financial institutions is value at risk. So hopefully in this portfolio construction, you'll be looking at value at risk. I'm not going to talk about benchmarks relative at the moment. I'm just going to move on to the next overhead. Ladies and gentlemen, I'm just going very quickly through this overhead. What this is talking about is something that we started off with, that when we try to create a portfolio, we need to understand what is the allowable asset groups that we can invest. And for each investment, we have to have a benchmark that we will use to identify that asset. It doesn't mean we are going to invest in the benchmark. It just means it gives you a general understanding about how that asset class behaves and how that portfolio would look like, generally. So I'm not going to talk too much about securities, but just to mention, derivatives needs to be considered very carefully. Most individuals are not able to invest in derivatives properly because they don't understand the risk involved in derivatives. So if you use derivatives well, it can be an amazing investment tool. It could also be something that can not just make you lose all your money, but maybe your wife, children, parents as well. So you've got to be very careful with derivatives. So what we are going to do is create a portfolio for this. I'm not going to discuss too much about the second points over here, those two bullet points, but go directly into this example. So if you don't want to read, if you can't read it from here, you can just look at this a roadmap for roadmap, because I've just pulled everything from there. And so you can go. So this is on page A2. It says Appendix A2. So over here, if you look at the investment objectives and goals and objectives, it says that the investment objective for the endowment is to preserve. Yeah? Do you remember? Oh, I'm about to run out of time. My light is blinking, so I've got to give you a break. But notice the word preserve over here. It's not for capital appreciation, but capital preservation. In real terms, so excluding the effect of inflation. It then tells you about returns and risks separately. All right? So what we're going to do is, because my light is flashing, I'm just going to pause over here. We'll have a 10-minute breather. I want to check if my recording went all right. In the meantime, what do you guys do during a break? Do you go out and play some cards, or do you get some coffee? Coffee? All right, go for a coffee and come back in 10 minutes. So we are sitting at all right, we're sitting at 10:30. I'll give you 10 minutes. So just have a quick coffee. Sorry, 10 minutes plus I need to have a cigarette as well. Come on.
Wait.
Sorry.
Okay.
Let me just do this.